here is the Oracle page that I have coming up for us to look at. I'll be discussing things like the power and physical infrastructure moat and the new jalapeno chip coming up from OpenAI. The details with IBM and how it makes its money are quite important. The AI Capex Squeeze mechanics is what they're blaming. They're saying enterprise clients faces massive global supply shortages of AI hardware, servers, storage, and high bandwidth memory. And they say in late June 2026, corporate IT rushed to purchase physical hardware assets to lock in the supply before anticipated price hikes. To fund these sudden hardware purchases, companies diverted capital, CIOs, Chief Investment Officers, diverted capital away from pre-allocated software renewals and digital consulting contracts. They took the money away, which used to be a core part of their spend and a pillar of their business budgets, and allocated it towards hardware, which is somewhat speculative about the future. They're worried about the future and they don't want to spend money on IBM. This reminds everybody of how in February Anthropic told people they might not have to. Evolving cyber threats and a frozen decision-making environment around the next-gen AI tools pushed clients to put major software deals on hold to late June. If in the July earnings we hear that those deals are then resuming and will pick up into the next quarters, the stock could recover back up the way and revert towards the mean, looking towards one of those blue or purple lines for a price-taking target. Up towards, for example, $260. However, if there's bad news, it can continue down to 178 or below. How does IBM make its money? Well, you've got three major areas. It makes money from software, it makes money from consulting, and it makes money from infrastructure. 45% of their funds that they earn are for software. Hybrid cloud anchored by Red Hat and HashiCorp is what it goes for. The Watson AI, Watson X, all of that stuff. And they have consulting. 31% of their income comes from that, which was 21 billion recently. This is boots on the ground systems integration. When they have consulting, it normally follows through with software and infrastructure purchases. Consulting being cut off is a big problem because it bleeds into other areas. There's also the infrastructure that they get money from. Well, a lot of companies continue to buy the infrastructure and purchase their Z mainframes because they need them. These companies are banks and they need the mainframes. Well, that doesn't mean they necessarily need to continue all of the software stuff, and they'll continue to lose the old software stuff on the new mainframe, and that is a problem for Microsoft's earnings because, of course, 45% comes from software and 31% from consulting. But there's a big difference between Oracle and IBM. Oracle had a slow grind. The prices of Oracle fell not just in a massive shock in one day, but over a period of weeks. We can look back to June where there was a high of $250 and we can see that there was a low of $125 more or less, and we can see that prices dropped 50% in the space of a month. It wasn't a day, but it was a long and painful grind down the way. What has been driving that and what's different to the IBM problem? Oracle stock slipped over several weeks because it's spending massive capex to build physical cloud infrastructure to host AI workloads. Investors worried about rising debt and potential dilution. IBM wasn't building data centers. It was on the receiving end of the budget squeeze. High margin software deals were postponed because clients spent cash on the hardware Oracle was building out. Oracle's massive spend on hardware means that IBM's clients can't afford to spend money with them. There's a massive structural split, and in the longer term, Oracle would appear on paper to be the winner from that. because there is a significant ROI for them to capture. Secondly, the COBOL and AI migration war. There are concerns about putting COBOL on the cloud. It is not really possible to do it efficiently. The Z mainframes that IBM sells are designed specifically to run that software, and they do it far, far, far more efficiently than any emulation can achieve on the cloud. IBM is hoping that this moat will bring customers back to them, because when they realize that even if they get documentation for COBOL, and even if they can migrate it to the cloud, it won't work and won't save them costs. But this is being tested right now in Japan. Japan has the same sort of issue happening now, but it's not Microsoft, or sorry, it's not IBM, it is Fujitsu. Fujitsu make the mainframes for the banks in Japan, and they run COBOL just like IBM's do, because Fujitsu has used IBM machinery to provide those customers with these mainframes. However, Fujitsu is sunsetting that whole part of their business and won't be making them past 2030, which means that they are already pushing their customers onto the cloud. But it's not quite working out yet. The main difference is the speed of the processing. What can take 10 minutes to an hour overnight on an IBM mainframe might take 6 to 8 hours to potentially a day if it's done on the cloud. This can be a massive problem when you're looking at processing the transactions of, say, your bank's 10 million clients. This needs to be faster and cheaper. But on the cheaper side, what you do get is the ability to use open source databases instead of paying Microsoft huge fees, or IBM, sorry, instead of paying IBM huge fees for the database. They save masses of money. In fact, it can be even up to 30% of their spend saved by using open source databases. This means that Amazon, AWS, Azure, and other cloud infrastructure companies are the winners in the end. If I mention Azure cloud infrastructure and I mention AWS cloud infrastructure, what's the next one on that list? Who is the missing elephant in the room? It is, of course, Oracle, who are the biggest, massive, growing provider of these data center cloud infrastructure needs. So mainframes can still win, and there is a question: can the code be refactored to run fast on these cloud services? And if it can be, then that means IBM could long term lose out on the hardware side of their business, which would be absolutely massive given it represents a third of their income, and as well the software side, 45% of income, could be cut out completely. However, it would need to be refactored code to run smoothly. That means that over the next few years, 27, 28, 29, and 2030, companies in Japan are on the vanguard of trying to figure this out. There's a battle going on, and this means bad news for IBM, who want to have people hold their stock long term as part of their overall everything must go up thesis, because in the US, stocks typically over the long term all go up, and Microsoft and IBM has existed for the last 115 years. If it doesn't keep going up, what does it do? Well, sometimes, every so often, these major elephants have to go off and die. If that happens, it would be the end of an era. Well, it's not written in the stars yet, and there is the possibility for a rebound. We need to see how it pans out over the earnings period.